So today we're looking at getting most from your tax-free investing. I'll do a small recap of what it is, but there's three particular tricks where perhaps we can actually get a little more tax-freeness from our tax-free accounts. We've got questions, drop them into the Q&A box. I'll take them as we go along, or I'll take them at the end if they're not time specific. I'm probably looking at about 15 or 20 minutes today. As always, disclaimer from Standard Online Share Trading, or SPG Securities, as they're officially called. So just a quick reminder, tax-free accounts, some 5 years old now. You can put 33,000 a year into the account and 500,000 a lifetime. That is per individual. Remember, a year is a tax year, so that is running March to February. It is not the calendar year. Only exchange traded funds, no individual shares, no derivatives, no exchange traded notes, and it must be in the tax-free accounts, either within online share trading or auto share invest within internet banking. In essence, there's the tax-free wrapper, and you can't designate, I want that account to be it. You have to practically open a tax-free account. And then you get reduced brokerage, 25 points brokerage, reduced straight, and no minimums, so nice and cheap to transact. And then it is tax-free. So there's no dividend withholding tax, there's no capital gains tax, etc. It is tax-free, absolutely and completely. So it does what it says on the sticker. When you draw the money out, of course, that money which is drawn out is no longer tax-free. And if you die with a tax-free account, it will be liquidated at no tax liability, and then it will form part of your estate. More than 3 million, there is tax liability in that space there. Typically, the question is always, where should we, what should we do first? And the math is quite simple. You should boost your tax-free account first. That should be your first 33,000 per year. Thereafter, you can start doing your retirement annuity. Remember, you get 27.5% or 350,000, whichever is smaller, is deductible from your income for tax purposes if you put it into retirement annuity, pension, provident, etc. But the math says start with your tax-free, boost that, and then move to your RA, and then move to your individual investments. Quick look at ETFs. So ETF, exchange traded fund, essentially it's a basket of shares. It's tracking an index, a basket, a methodology. So you'll find an ETF on the top 40, which is the 40 largest shares on the JSE. Core shares have got a top 50, also for the JSE. S&P 500 out of the US, the Indy 25, the 25 largest industrial stocks on the JSE, etc. So they're nice, they're diverse. You don't have single stock or single event risk. The top 40 and the top 50 both held Steinhoff when all that chaos went down in December 2017. Was it 17 or 16? Now I'm starting to doubt myself. 17. But either way, it destroyed Steinhoff, and it slightly hurt the ETFs. They're cheap. The top 40 from Satrix is at 0.1% total expense ratio. That is a capped ratio. We've got the Signia Itrix S&P 500 at 0.16. Some do start to get more expensive, in particular the smart beta ones, which have got methodologies using to track them. So they will say we want shares with certain fundamental ratios to be included, and there'll be extra fees in that. And then, for example, Cloud Atlas has got the ones into the rest of Africa, and they're more expensive because it is more expensive to transact into the rest of the continent. They're simple, and what's important is they're self-correcting. So my ETF, some of them held Steinhoff when it went bust, and they worked it out, and it's no longer there. And the reason I mention it is there's a lot of concern, particularly around NASPAS, which is sitting at plus 20%. Now, the unbundling of process should in theory help, and I pause there, we'll see, but we might end up with a lot of process and a lot of NASPAS that's still at plus 20%. But in the early 2000s, it was Anglo-American and Billiton that was plus 20%, and that's no longer the case. They do autocorrect, they do fix themselves, and that they'll get, that they will have overweight exposures at a point. And in fact, our top 40 is no different. What you typically find is that it's around about a quarter of the stocks, in fact, oftentimes less, that actually drive the return of the index. And that's the same from ours, top 40, S&P 500. The sort of 50 stocks at the top are what's driving the return. The other 450 aren't. In some cases, in Italy, that return has been driven by just a handful of shares. So the concentration is a factor of indices. Unless you go equal weight, the JSE tried the Swiss index in the early 2000s to solve the problem with Anglo American and Billiton, and that actually just created a monster because NASPAS is even bigger in Swiss than it is in top 40. But ETFs are simple. It will be 19 years in December since Satrix launched their top 40 back in December of 2000. And they do, as they say in the sticker, and that's hugely important and relevant. You can't put all ETFs into your tax-free account. There are local and offshore. We've got Africa, we've got property and bonds, we've got the smart beta, which use their own bespoke methodologies. No commodities, no ETNs. The list, if you log on to online share trading, under instruments, second to bottom, tax-free investment account enabled instruments, those are the ETFs that can go in. Quick point to ETNs and commodities. So I suspect the issue around commodities, although we have commodity ETFs, was that you could have everything in gold, and gold could collapse. Now, gold can't do a Steinhoff because it can't go bankrupt. But, could gold lose half of its value and never recover? Sure. Could an index do that? Short answer, no. So that's why no commodities. ETNs are exchange-traded notes. ETF is exchange-traded fund. The ETF, the issuer, Satrix, Standard Bank, Stanlib, whoever it might be, physically hold the shares in a special purpose vehicle. So if the issuer goes bankrupt, no worries, your shares are there and you will get your net asset value. It might be a little bit messy, it might take a bit of time, but you will get it. An ETN is a note. In other words, they're promising you the return. In other words, you're taking basically credit risk. In other words, if that issuer goes bankrupt, then you find yourself holding a credit note for a bankrupt institution, and essentially you join the list of other people who are owed money. You will be ahead of normal shareholders, but pretty much behind pretty much everyone else. Typically, tax first, then senior debt, bonds, preference shares, and so that list goes on. But within the tax-free investment accounts, we have got way more than enough. More than 70 instruments. Apart from individual ETNs, there's practically nothing that we can't do. So what I want to look at today is now, as I said, we're 5 years in. If you're putting your max money in, you've put in 160 odd thousand into the account. It probably hasn't done very much because it hasn't been a very good period in our market locally. And when the US has done well, a lot of that shine has been taken out by Rand strength. But there are a couple of small nuances where we can be a little more efficient in terms of the tax liabilities and the tax potential savings when we're looking at what's in an ETF. The first one is offshore ETS. So offshore ETFs have a tax at source. And what I mean by that is, let's say you buy that Artrix S&P 500 from Signia. That ETF is obviously buying the shares that are making up the S&P 500 in the US. They are paying dividends in the US, and those dividends are taxed in the US. And the US doesn't care about our tax-free accounts. So we can't, so you can claim some of it back. If they go the route, they can claim some, but there is going to be some drag there. And the issue is really quite simple. That you simply, there's going to be some tax paid on dividends that the IRS in the US is going to say to you, sorry, who are you and what's the tax-free account? So we can't claim back all of that dividend. It is a small amount. By my calculations, at most, maybe it's 0.1 to 0.3%. But it is a drag on returns. If one of the ETF issuers was dropping their fees from 0.1 to 0 or from 0.3 to 0.1, we would like it. We would like that extra point whatever in our pocket rather than somebody else's. So there is a small drag, and then the point is maybe your offshore ETFs shouldn't be in your tax-free. Now, there's a proviso here. I'm assuming that you've got your tax-free maxed out, and then you've got other investments. If you're only doing the 33,000 a year, or not even getting to the 33,000 a year, then carrying on, and don't worry about it. But if you're maxing out your tax-free account, and then you've still got money that you're buying other ETFs in a normal tax payable account, then perhaps your offshores go in there rather than in here. Question coming from Gina: has Signia totally divorced from Deutsche Bank? If it goes bust, is there risk? Yeah. So Signia bought the ETFs, what were called the X trackers, and is now iTrix. Those covered the US, the MSCI US, the UK, the Europe, the Japan, and a world, which is the MSCI developed market. And those are completely separate from Deutsche Bank. Deutsche Bank goes bust, you've got absolutely no concerns. There is, however, still some Deutsche Bank ETNs, and there is risk if Deutsche Bank goes bust and you hold those. Those are China, Africa, BRICS, and that sort of thing. I don't think Deutsche Bank's going bust, but that's a call you need to make. But Gina, to your question, Signia, the ETFs they bought from Deutsche Bank have no bearing on what happens to Deutsche Bank whatsoever. Question from Mark, and he raises the point, and Mark's 100% correct. So here's the thing. If I move money offshore and I take dollars and I stick it into a US account in the US and I go by the VOO, right, which is the S&P 500 tracker from Vanguard, and I make money, and the currency weakens, I'm not being taxed on the currency weakening. So I took money at 12 Rand and the currency is 14, and I've made that extra $2 a dollar, not taxable. But if that happened and I've bought the ETF on the JSE, my return is both the currency weaken and the move in the S&P. So there is a tax hit there. The trick is, Mark, is that simply what you're doing is if you take the money offshore, you obviously get zero tax benefit. But there is certainly, therefore, some folks are saying, no, they put their offshore in to benefit from the currency and not having the tax implication of it. To me, the offshore ETFs is a small one. I put it up front because the next two are more important. And I have some offshore in my tax-free account, and it's not stressing me. But I do a monthly debit over and above, and that's where I'm putting offshore. The biggie is property ETFs. So properties you're typically buying for a high yield, right? You can get sort of, I don't know, what are those yields now? 6, 7, 8, 9% on those ETFs. But the distributions are taxed as income tax, not as dividend tax. So dividend withholding tax is 20%. But you're not necessarily paying 20%. If your marginal tax rate is 30, 40, 45%, that income from the property ETF gets added to your income and gets taxed at that 30, 40, 45%. So potentially you're paying a much higher rate on the distributions on property ETFs, depending on what your tax rate is. And therefore, property ETFs should absolutely be in your tax-free account. If you're paying, and you need to know, if your marginal rate's under 20, okay, it's much of a muchness, truthfully, nothing to get overly stressed off. But if your marginal rate is above 20, then property ETFs should first and foremost go into your tax-free account because you're saving on the taxability of the distributions. And that can be, if your marginal tax rate is 45%, that's a significant saving especially because property ETFs are, by design, they pay a high yield. So you've got a higher yield, but the higher tax rate means you're getting hit on it. So property ETFs, absolutely stick them first and foremost into your tax-free account. And this goes back to the point. Let's say you're putting 100,000 a year into ETFs. Well, 33,000 into tax-free, and then the other 67,000 will just go into a normal taxable account. Make that 33 property. Now, maybe you only want 20% of your ETFs you buy every year property. Fine. So 20,000 of your 33 goes into property and you're tax-free. The other 13,000, well, hey, you could put it in the offshore to get the rand gain, etc., etc. So international property, nope. Well, so international property can be, but the way that by the time when we receive it, we are receiving it as dividend. It's the local REIT structures that we have in South Africa. So Steve, I'm not so stressed about the international property. And what we find with international property is that their yields are typically not nearly as juicy as ours. I was on the TV last night, Nassim Nair from Sasfin, and he was, maybe it was Gary Boyson, one of them were mentioning that Johnson & Johnson is a high dividend paying stock in the US, and that dividend is 2.9. in South Africa, 2.9 is not a high dividend. And we're talking equity here, not property. 2.9 is nice, but it's not giant. In the US, because of the high level of dividend tax, a lot of these days is they're doing share buybacks instead of dividends. But local property ETFs, definitely put those into your tax-free account unless your marginal tax rate is really modest. And then bonds and cash ETFs. So we've got a number of bond ETFs, and again, I'm looking at the locals. We've got some inflation linked. We've got some Orbeez, the all bond index. We've also got the Tracy from ABSA, which is basically just cash and earning interest on that. They pay income. And that is therefore or interest, and that is taxed at your marginal tax rate. But remember that as an individual, if you're under 65, your first $23,800 a year of interest is tax-free. If you're over 65, your first $34,500 of interest per year is tax-free. So if you're buying bond or cash ETFs that are paying interest, don't buy them in your tax-free account unless the interest that you are as an individual is above 23.8 or 34.5. In other words, use that free allocation first. If you're earning interest of $50,000 a year on your ETFs, bond and cash ETS, then sure, put half of them into your tax-free account and then leave the rest, because that first $23,800 that you get is not taxable. It is tax exempt. Now, the Treasury has not increased those numbers, and I think Treasury is not going to increase those numbers. I think Treasury's view is that the tax-free accounts are really where we should be putting our interest and getting that exclusion. And of course, the trick is $33,000 a year. That's why they've left them in place. But whereas Minister of Finance used to adjust those numbers higher, more or less by inflation every February, they are no longer adjusting them higher, and it has stayed where it is. So the first amount of interest at 23.8 or 34.5 should be in outside of tax-free. Any interest you're earning over and above in your tax-free. And this can just be, there are issues out there who just give you cash accounts that are tax-free. Now, I don't like them, but if that's your stage of life, then absolutely that's what it is. Steve, you're getting about 6% interest on the Tracy. NFTRACI. They don't call it Tracy, they call it Track I, but I think Tracy's much better. NFTRACI, it's about 6%. It accrues daily. So it's nice. But at this point in time, truthfully, you're getting way better interests at bank accounts. Whereas when the Tracy first came out, interest rates were lower, and you were getting a decent rate on the Tracy, and it was comparable. These days, less so. But I mean, some folks are putting government bonds into your retail government bonds into tax-free, and you can do that. And they're paying decent rates, so around 8% and the like, so the rates aren't bad. But certainly what you want to be doing is making sure that that first interest comes to you in a normal account, because it is exempt already. So in closing, you can correct your tax-free holdings. If you've looked at this and you thought, I've got all my property ETFs there, and in my tax-free, I've gone and put my top 40 ETFs. Well, you can trade out of your top 40 ETFs in the tax-free and switch into the new one. That is not considered an exit. Sales are not exits. As long as the money remains in that tax-free account wrapper, it is still within there. So you can rebalance that portfolio. And that's what I've been doing. So I'm of the view, and have been since late last year, that property's the cheapest it's been in 10 years in the listed property space. Your yield is above the 10-year government. 10-year government's about 8, property's about 9. That always indicates value. And you're buying the properties at or around net asset value, and that also indicates value. In the last 10 years, you've had yields below the 10-year rate, and you've also had prices 20, 30, in some cases 50 or even 100% above net asset value. So I'm very bullish a listed property, and therefore I've been switching out of other ETFs and buying listed property in my tax-free, because I get those nice yields. Question from Sean, which one have I been buying? I've been buying Satrix Pro, STX PRO. I also own some PropTrax 10, which I currently have, and those I'm still holding. Ben, I see your questions. I'll come to them at the end. We'll go log on. We can have a look-see. And Stephen, I answered the question. So Satrix Pro, STX PRO, and then the other one that I have is the PTX 10, which is going to be changing at some point soon. The Satrix Pro, what I like with it is that it's capped. The new PropTrax 10, when they merge the two and change them from core shares, I think we will have a better ETF when that comes through. It'll have more, and it'll be focusing on yield. It's going to use yield as the metric. So first there's a filter on liquidity, then there's a filter on yield, and then there's a filter on size. Yield will compensate 75% of the weighting, size 25%. In other words, you buy property for the yield, and property yield is exactly what you will get from that new one coming out of core shares. I can't remember the dates, but it's happening. The voting has happened. That change is going to happen. I think it was last week, July, which means this week or next, or otherwise it's early August. So you can rebalance within your tax-free to your smartest position. Now, what I have is my tax-free portfolio, then my other ETFs are non-tax-free, and I'm constantly balancing between them. There is an issue, of course, that the ones outside of the tax-free, if I've got profits, then I've got tax liability potentially. So tax-free is working. It's doing as it should said on the sticker. Your local property ETS, best in a tax-free. Offshore, perhaps less so. Your call on the currency. And cash only above the limits already allowed. And as someone's saying, I don't have cash. Should I have cash and bonds? The answer is no, unless you're looking for a very low risk. So typically when you're at the point when you're starting to draw down on your investments, you want to have some cash and bonds, i.e. you're in retirement. If you're not, don't worry about it. And as I said, if you're not yet putting the full $33,000 a year into your tax-free account, then don't worry about this. Just carry on carrying on. I mean, just carry on doing your investments on the regular basis. What we're really looking at here is if you've got excess of 33. But do fill your tax-free first every year. Your first 33,000 of discretionary investment goes into your tax-free. Thereafter, we can debate what's good, bad, or ugly. But your first 33 into tax-free. Ben, you're asking about the So if we go instruments and I go to tax-free enabled products, there are a couple of bonds. We've got some local and some offshore. So there's an Ashburton global bond. There's the Ashburton inflation-linked bond, ASH-INF. Let me do that. Oh, I'm in the wrong browser, so I can't do that. Okay. And then more coming up in a moment. Excuse me. We've got more global bonds here from Stanlib. And then we've got from these folks here, there's your government bond index. And again, the OB is a inflation linked. And even if they are a total return, they're not paying distributions. You get the distribution, they reinvest, so there is still a tax issue. There's the Tracy we were talking about. I'm going to go have a look at that in a moment. I'll show you how that just goes up in a very, very straight line, exactly as it should. And then there is a Satrix inflation-linked bond at the same time as well. The way the inflation-linked bond works is that the capital goes up by the inflation amount, and then you get paid a coupon on top of it. If you go to the government bonds, you can see that they pay about, I think it's 3.5% over and above, but you get inflation. So your capital increases inflation, and then you get the 3.5% over and above. NFTRACI, next to Spooky there. And why did I get the name wrong? Yep. Where is it? ABSA, NFT. Where are you? And now I'm just gone totally and absolutely blind. There it is there. NFTRCI. I thought that's what I had. So if you look at that, that thing just goes up every single day. So it's actually over 1 year, it's paid 7.1. Stephen, I think you were asking that question. So over a year, it's paid 7.1. Your 3-year return is therefore 22 and some change. 5 years is 38 and some change. and 10 years goes back to its listing, so it's moot. But what you can see is over the 5 years is it just tracks up. Ignore the spikes. Those are dirty close levels. It's just adding you what is 7.1% effectively per year. So Ben, if you're over the interest level, then take the excess and start buying things such as Tracy's or the bonds, and put it in your tax-free account, and then you can benefit from that at the same time. And if you've already got in the tax-free account, you can switch out and buy that. My preferred is going to be the Tracy or the NF Govey. Is that the right name? Yep, there it is. So here's the NF Govey. And you can see fairly steady. It is reinvesting dividends for you, but there's still a tax liability there. But what you can see is it's giving you a better return than the cash. So over 1 year, it's giving you 11.1 instead of 7.1. 3 years instead of 22, you're getting almost 31. And 5 years, you're getting 47 instead of, what was it, 30 and change, almost 40. Where do we find each info on each ETF? Good question. So if you boogie down there and you go to the TFI enabled products, they're not giving you a heck lot of information. There's basically going to be two ways you can do it. The easiest way is to take the share code and Google it. So let's take that, stick it into Google, and what we should get is there's a Cloud Atlas, and what you're looking for is, and that was a bad example, truthfully. So let's go with STX 40. You don't want the ShareNet, you don't want the ShareNet, you want the Satrix Now. So this is their page where you can find that information. Otherwise, justonelap.com/ETFs. Christopher van Heerden does a weekly review of that. Gina, there indeed is, and I'm going to give a shameless plug to Just One Lap, but it is well worth it because we reviewed it today. There are two MAPS products from ABSA New Funds. New Funds is the name for their ETFs. MAPS Protect and MAPS Growth. And what they do is they do a blend of shares, bonds, and cash. So the Protect one has a fair bunch more in terms of bonds and cash, and the growth doesn't. And I'm just checking. So you've had decentish returns over the period because those bonds and the cash have been working in your favor. So the one is the MAPS GP, and the other is the MAPS Growth. And let's go have a look at MAPS Growth here. MAPS Growth has a higher weighting of equity in it. So we'll give you a little more volatility. So less good in 1 year. 3 years is okay. 5 years, not bad. 24% of the last 5 years. What has Satrix 40 done? So our market has done 11.5 compared to the MAPS Growth, which has done 24. So it's more than doubled. Now, obviously, in a strong equity market, it will underperform as equity beats bonds and cash. But they're both great products in that sense. I'll send you the codes MAPS G and MAPS P. Are dividends taxed in a tax-free account? Stephen, no, they're not. Dividends are tax-free. Where you do get hit, as I said up front, is the offshore dividends. So if you're holding an S&P 500, etc., but you don't pay. Back in the day, dividend tax, when it was first introduced, secondary tax on companies, STC, was at 10%, and you could offset, and so it was really little or nothing. Now it's 20%. Now it's chunky. On global levels, 20% is the mid-range. I think the US is 30%, so it can get fairly hectic. Ben, you say that over the last 4 years, money market performs better than these ETFs. Yeah, you're 100% right on that. Money market has done better. And then you've got, as I was showing you, we've got the bonds and we've got the NF Tracy. So NF Tracy has beaten our market over the last 4 years, although maybe not over the last 1 year on Satrix 40. Nope, even over 1 year. So at this point, cash is beating everything. Yes, Steve, all the ETFs I've spoken about today are available within the tax-free, Standard Bank tax-free. So as long as you meet the rules of Treasury as to what can go in, and that leaves 70 odd ETFs available. As long as you meet those requirements, then absolutely you can use into the tax-free. Standard Bank is not that they offer all of the tax-free compliant ETFs available. If we go into it, I mean it's a chunky list. I still remember the days when there were only a dozen ETFs. There were the Satrix, there were the couple of 2 properties, and then the DBX trackers. And that's a giant size list. I mean, and it gives you loads. I mean, we really have giant size lists in that space. Now, if I had to choose only one ETF, so I'm going to give you 2 halves to the answer. If I had to choose only one ETF, not for my tax-free, if I had to choose only one ETF, I choose the Ashburton 1200. So this is a global ETF. It's got a slightly higher TER than many of the others. The reason why I like this over the other S&P 500, etc., is it's global, so it's got more non-US exposure, and it also has about 7% emerging market exposure. Whereas the S&Ps get emerging market exposure indirectly because, of course, Apple sells iPhones in Johannesburg, Cape Town, Durban, Rustenburg, etc. But this is my one ETF to rule them all. However, what I do, although I say this is the only, so every month I have a debit that goes off using AutoShare Invest and internet banking, and I buy this ETF. But my tax-free, I've loaded with property because of the extra, and local property because of the extra tax. So I'm giving you a roundabout. Yeah, Dow, that's it. And short code is ASHGEQ. And if you go to justonelap.com and search for that, you will find a podcast that Christia and I did that. Let me, ETF to rule. So we looked at the idea of one ETF to rule them all, and this is the one that we came to. What do I want? I want to copy link. I'll send that there. You can go give it a listen. Yeah, there we go. That went to everybody. So that focuses on the idea of one ETF to rule them all, and why we did that one. Mike, pref tracks. I like the pref tracks. I hold a lot of it. The change is coming, and so I always liked it for the equal weight. PTX 10. I like the equal weight. Pref. Mike, are we talking the preference shares one? I think I'm going off in a bend on property. Yes, I am. So we're talking pref TX. So this is great. This is a great yield. What's the yield on it currently? 7.2, and that's net of tax. So that yield is what, about 8.5% or there's about. And what you're going to get here more than anything is you're going to get yield. Now, you have over the last year got really good capital appreciation. This thing has a low of under $8 in the last year. And if we go back further, I think it actually went even lower. Yeah, so under $8 was the low. That capital appreciation is not the norm, but you get a really chunky yield. And if you've got this product, it is best going to be served in a tax-free account so that you don't pay the dividend tax. Stephen, how do you know if dividends are reinvested and not distributed to the client? There is no easy way to know that, is unfortunately the answer. So there's a cheat way of doing it. When you're looking at the one in particular, and NF Govy, so you head to NF Govy, you look at dividend history, no dividend. So this is total return. Now, what's happened here is that sometimes for various reasons they make a small payout, but technically they don't. But there's no, this is your list of total returns. You basically got to go and check each one individually. For example, those MAPS growth ones I spoke about, they declare a dividend, but they don't pay it. So if you look at online share trading, you don't see the dividend being paid. If you look at the minimum disclosure document, you see it, but it's reinvested. So there's no, I know what you're looking for, and it's unfortunately just not there. Satrix RAFI dividends are returned, but what they do is they give you a small payout. Dividends are reinvested. What they do is they give you a very, very modest dividend payout. And the reason for that is, so basically, let's say you got a R1 dividend accrued to you. They pay you 20 cents because that is your tax liability. And then they reinvest the other 80 cents for you. Now, I remember when the dividend withholding tax came in and there was a lot of if, buts, and maybes, and there are certainly different ways of doing it. This is how the RAFI does it. And I'm noticing no dividend for 17, which is weird. But in essence, what they're saying is, we're just going to pay it to you. We're going to pay you the tax component because there is a risk that you then you're forced to be double taxed because you don't have the cash flow for the dividend. So what do? You now got to sell some of the ETF, and then you get a CGT hit. So you got to pay CGT in order to pay dividends. And no, SARS is winning there. Aside from SARS, ain't no one winning in that space there. And this has been a good little ETF. I think my sister owns it or someone. 3-year return up 25%, and 5-year return when our market has done practically nothing, 23%. It's done very well. Ladies and gents, I'm not seeing the questions come through. We've hit our time. We shall park it there. Appreciate your time. Appreciate the questions. Video will be up on the online share trading later this afternoon. Everyone, have a great day further. Cheers all.